None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Monday morning, another getting set for another week to buzz by faster. You can say it. Last week was, I don't know what happened to it. It was very fast, it seemed anyway. It seemed like it was Monday and then it was Friday. So we have some interesting action going on today. There were a couple economic reports that came out. We had housing sentiment, I think builder sentiment, and it was a little better than expected, but nothing to be excited about. And it looks like we're just kind of getting into the wait for the Fed mode on Wednesday. It looks like the volatility is going on. Let me bring Mitchell in with this. I'll switch locations. I'm going to trick you. Good morning, Mitch.
Good morning.
So
Happy Father's Day belated, I guess I should say.
Oh yeah, to everyone, yeah. So like I said, the building report came out. Wasn't really much there. It was expected 46, and it was 49, so a little better. Not sure actually how they get the builder sentiment. Do they call a bunch of builders, I guess, and say, how do you feel? And how do they get to 46 or 49? I don't know how they do that. You have any clue, Mitch?
I don't. It's a good question. I'm going to have to read
it seems made up, right? Okay, well, they were feeling pretty good. Let's give them a 49. Anyway, I'm not sure how that one works. Maybe if somebody does know, maybe we should look that up, but it's kind of an odd number. And then we had the Empire manufacturing number come in much better than expected. And so, we're continuing to see the same story unfold. And then, of course, the big story in the background is the whole thing going on in Iraq. Are the wheels going to completely fall off, and the terrorists be in control or not? I guess this ISIS group has managed to amass $2 billion. So good job, I guess, in amassing that kind of wealth. And that seems a little scary for, I guess, from the standpoint of having terrorists having $2 billion.
Yeah.
I guess
obviously, a lot of people taking out $10,000 or less withdrawals from that Patriot Act, right? Isn't that how they get funded?
I'm not sure, but they, it's I guess there are friends in Syria, but are enemies in Iraq. I don't know how that works, but anyway, just a mess over there, and I feel sorry for all of us and the sacrifices that we made to get that place to see it in the phases that it's in. But the backdrop is geopolitical risk, and the real backdrop is crude oil, which we'll go over today as we go through it, just to see if we can build any technical expectations around the crude oil. But that's the backstory, I guess, right now. And it's interesting because every one of these stories, I talked about this several times in the past, we live, okay, this is the crisis that's going to take the market down. There's always the next crisis mode, because that's how we're used to expecting after the 08-09. We just keep waiting for something else to show up that takes the market down, and it's, whatever. And it doesn't seem to come. So we get all of these things. So I guess we'll just have to watch this one and see what goes on. And Of course, guys like Boone Pickens are running around screaming, the sky's falling and crude oil is going to be $200 a barrel and gasoline will be $8 this summer. We'll see what happens. No one knows that. So we'll just continue to watch, but we will look at some of the technical expectations of the markets and those from the crude oil standpoint, and maybe Mitch, maybe while I'm talking about some of this stuff, maybe you can hunt down like the oil index ETF or something like that. Maybe we can see if there's anything evident there as well, and we get to that section. But yeah, anyway, it's just kind of a continuation of the crazy world we live in. But on the economic backdrop, we continue to see incremental improvement. Overall, sentiment seems to be fairly firm. And we'll go to the markets in a minute. We'll look at some of the volatility we've already had today. Pretty narrow range, but there doesn't seem to be a lot of commitment that folks are willing to make, at least at this moment. So anyway, let's go ahead and go over there for a minute, and let's take a look at a couple charts that are coming up here. And so I like my lamp is right in the way, so I'm going to give me a second. I'll fix this real quick. I know what the problem is. It takes just a second to fix that. I'm not sure why that is coming up at the moment, but you will see it's magically gone now. So anyway, but this is the 24-hour futures charts. It's interesting because we had a cycle come in. I'll open up the hourly chart first. And in fact, let me just bring that up without me in the way. I had slid this over a little bit just so we could see more of this. Let me bring it back into reality mode here. But what you can see here is these cycles that come in every morning continue to come up, and the actual spike in volume was pretty light this morning, but the spike in the swing index suggests that little retracement off of the highs that we made earlier today, this is probably the low, and this is what I call the wait for the Fed pattern. There's really not a lot of suggestion of either directional movement. This is like an hourly chart, so not a lot going on. There was a cycle that came in right at the high, and if we look at, it was interesting because the short-term cycles, if we go over there real quick, you'll see the short-term cycles came in the cycle pretty much on a low when it rallied up, and now we're probably about another hour. Let's see if I can see what this cycle is. This is a 45 period cycle, so that's about a 2 hour and change cycle that's coming up. So we're well into the first hour, so probably another hour or so we should see a cycle set up if we're trading down into that, and we are holding above this level that I talked about in commentary last night, the 1930.10. So far, the low on the cash market's been, I believe, 93 has been the low there. Let me just flash over there real quick. But I believe the low has been, let's see here. Yeah, 1930.91. So we stayed just above the S2 support, and then we rallied up just below the the R2 resistance. So we probably have finished the bulk of the range today. We're still running about a 12 and a half handle range on a 3-day indicator. So we're just kind of working the range, and since I have these charts up, we'll switch over to the cash markets here. You'll see that this rate of change on this on the volume rate of change here is drastically down, which suggests that this is typical. Maybe it's because I have some dyslexia that this is looking like it is, but typically these low volume spikes like this are usually points where the market stabilizes, starts to make a turn. Most people talk about increased volume, high volume as a point. I see it a little bit different, that the high volume oftentimes is climactic. The low volume is where you start to see turning points comes from that from that point. The high volume spikes on the upside or downside are usually not the indicative that I guess the media would say, oh, it had high volumes, so that means there's more. No, that means probably everybody that could buy or sell has already done it, and now you'll see a contraction of that volume, and volume tends to be one-sided when you see that anyway, whether it's up or down. So these patterns that are unfolding continue to just kind of suggest at the moment more of a sideways pattern. So this has been a pattern that we've seen, for a long time. We went 13 weeks sideways, and now we've moved the market up higher, and now we're trying to get to the point where now it's going sideways again. So it's stair-stepping in an upward range here from that standpoint. So it goes higher and then sideways and then back and then levers up again, and that's the pattern we've been seeing. Looking at, let me go over to this chart here. We'll look at the weekly index, and you'll see that we're starting to see some acceleration this week. I don't know if those of you, I know we have several folks that watch this all the time, but we're at 0.63 on PPM1, 0.37. Let me get me out of the way here so you can see this. And the 0.63, 0.37, and 0.33. So the trend is expanding. The actual moving averages that are showing up here are continuing to see where they're spreading apart, where the PPM1 is moving faster than the other two averages, which is typical in an expansion from a trend following standpoint. So we're looking at right now, see PPM, this thing was 40, let's see here, where is it? It was, PPM1 was 38, and now it's moved to 63. So it's jumped substantially. Anything over 0.25 is a trend, and the fast moving average now, or the 10-week moving average, is 1901.05. And if you look at our weekly posting of our numbers that come out every week, 1907.75 is a extreme for the week. My expectations are we probably don't see much under S1 on a weekly, which is 1929.45 with the if it got through there, then 1921.95 would be about it on the downside. I suspect we're going to stay pretty quiet. I would expect that also that our friend Janet Yellen is going to continue to be, I guess, dovish, if you will, from the standpoint of how she's going to approach the markets, and as far as the as far as I guess the Federal Reserve goes, we're going to continue to see some pulling back of the QE. We're going to continue to see all the things that we've seen. There's not going to be anything new, and they're going to continue probably the same dialogue that they've had for a long time. I can't imagine with economics reports that we've seen since the last event with the Fed that anything's really changed drastically. The real estate is kind of up and down depending on what day they check it. It's good or bad. As I've talked about before, at least over here in former ground zero for the real estate crash, we're still a long ways from recovering here, and we're not seeing the type of sentiment from what I've been hearing anyway through the grapevine with some of the realtor friends that I have, that the builders are that excited about what's going on here. So maybe they were a drawdown. They didn't get a number 49. They only got a 43. Maybe they were unchanged. But there's not a lot of positives going on anyway. There's some building, but nothing drastic. So let's go ahead, and as we see this PPM starting to accelerate, let's go and take a look at the short-term basis and look at the daily charts right now. Daily charts are more in a corrective phase, so looking at how things are going, I'm going to start over and go daily, weekly, and then go monthly. So we go to, like I referred to in the past as the super slow-mo. But right now, the short-term chart, or the daily, is suggesting that this thing is in a sideways pattern. I mentioned in commentary that we could go up to around the 1950 to 1957. That would be a retest of the highs. But the way that the patterns are set up on a short-term basis, it doesn't look like whatever rally we get, at least in the next day or so, are going to be the initial breakout point. If we can get above, I think on a closing basis, the 1957.90, then that will be a new high, but that will propel us toward the 1973 objective number that I've been talking about. There's about a 60% probability we're going to see that number in this pattern, and we're likely to see that probably this week if we can get through these numbers with the Fed response and things that are going on there. So I suspect that our top end of our range will be somewhere between the S3 and the extreme on the weekly, which would be 1957 to the 1964.60 level. So that'll probably be the upper end of the range. I suspect to see us continue to move forward. So far, the Fed under Janet Yellen hasn't misstepped from the standpoint of messaging and keeping most market participants in a pretty strong mode there. So that's pretty much what we've got going there. So I think what we'll do next here is we'll go in and I'll bring Mitch back in here. I think we can both get in. He's kind of a floating head at the moment, but we'll go ahead and discuss and go through some of the trade impact charts and start to look at the activity in BPM. And then when he's done with that, then we'll go back and we'll look at treasuries, we'll look at crude oil, look at some of the other items to get a perspective of what we're likely to see from this deal. So, Mitch, why don't you go ahead and drive there?
All right. Well, this week, going on to the main page here, you'll see that we had some net buys. We're still working on a chart to give you a better summary from week to week as to what the changes were. So that's something I'll be working on this week and get that out in some of the next couple broadcasts. But just taking a look at the sector chart, you see that we had more buying than selling this week, with the exception of the telecommunications services, which had more selling than buying. Breaking it down, if you go over to funds, you'll see that really the concentration that we saw was in the sector equity space, and especially in that space, it was actually real estate, interestingly enough. So it looks like we got some fresh buys in the real estate sectors just before the new home builders announcement here. So when we click on this, it'll drill down to just all the funds that are in the category of sector equity funds. You can see that the largest purchases were in the global real estate, where we had a 25% tranche of new orders. And then in the domestic real estate, we had a 16% tranche of new orders. And this puts us at right around 95% invested for the total real estate when it comes to the funds that we track within the system. So I had quite a bit of buying, at least in the sectors. Everything else, really, it was just sort of the continual inching forward, getting a little bit more and more exposed to the market. Bob, you had said in the commentary, was it 59% that we're now sitting at as far as the total database?
Yes, it is 50, and one of my key numbers that I look at there is actually the around 64%. We start to switch from back into an expanding mode. What we've seen for the most part from the database is a rotation that's going on, and that's kind of building things up from there. I see Mitch is playing with all the graphs here, so we'll go over and show that. So if we, I'll go ahead and drive here. We'll take some of the stuff that's going on with the sectors and groups. We're 58%, 59.17, and groups are 40. So we're about 50-50 on the actual groups here. We're not really seeing any expansion from there, although I think we're down to 2 sectors at one stage. And I think it has expanded a little bit from the scope of what we're holding. So, but once again, not a lot going on from the database, but we're still looking at one of the big concentrations is energy. Interesting enough, 12.8, and of the entire database is actually energy. These also are representative. There's a lot of technology and industry, and the energy tends to be a couple of the bigger sectors as far as number of stocks anyway. So it's a little biased just because of the way that the database is configured. And right now we've got 18,367 symbols in where we're tracking in the database. So it's a pretty robust environment that we've got. And there's really nothing else that stands out here. I looked at this over the weekend as far as the duration and those type of things. We're looking at duration filled on the optimized right now. Only about virtually nothing, I guess, 0.26296. So a lot of this database has rolled. We went from 42 to about a 59. So we've seen about 17% of the database. So we're talking quite a bit of symbols. We're talking about 25, close to 3,000 symbols that have come in, brand new buys over the last 6 weeks. I think we don't really have a chart that shows that right now, do we, Mitch? As far as
not yet. That's what I'm working on right now. That'll be putting out. But yeah, I mean, over the last, let me see here, I think 6 weeks.
Yeah.
Just doing a quick tally. Yeah, we've had 6,000 new purchases across the board. In that same time span, we've had about 4,000 sells.
Yeah.
So I mean, total net, it's around, we'll say 2,000 of new positions taken on.
Yeah, and we've got a massive database, really, because there's probably most of the screener services you'll go to, they have about 10,500 stocks. So that encompasses all of the mutual funds and ETFs and all that as well. So it's a pretty robust and diverse database that we're looking at when we're looking at what the percentage long is. So it's pretty substantial. I believe in the research, though, we're really focused for the most part on just some of the sectors and stocks, but I guess it's not, is it? It's actually, it has everything in it now that I said that.
It does, yeah.
Yeah. So nothing here really to look at. So we'll go back to our we'll go back to TradeStation then, and take a look at what's going on there from looking at treasuries and those things here. So let me get to the right chart so we can get there. We'll take a quick look at treasuries. They are stuck in the mud, as we discussed, although a lot of the downside, this is something I discussed a couple weeks ago that was going to happen, and it's happening, because it was just as we moved off of the lows once we hit the 240 level on the 10-year, and we've come back to 262, we've seen the PPM start to lose a lot of their downside momentum. So this thing was a huge number, minus, I think, well, here, we can see exactly what it is here. Let me just bring this up so we can see that and move that over so we can put it on the screen here. But yeah, so we got down to minus 41, it looks like, minus 111 on, it was pretty substantial. So we went from over 1% decline on the 10-week moving average to virtually flat. So the momentum's down. The market is now set, or getting closer to being set, for that rise in interest rates that I've talked about, and getting maybe getting above this 262, 268 level, which is going to continue to be a point where interest rates are going to hold at the moment. We still have quite a bit of the bond segment long, I believe. We didn't really go through that part of things, but I'm gonna flash back to the dashboard real quick. And utilities is just pegged over here. You can see that. So a lot of the interest sensitive stuff is continuing to be pretty pegged. Is there a place where we have the bonds? I guess under funds, huh?
Funds, yep.
So under the funds, we'll take a look and load this up and see what we've got here. But taxable, 82% long, pretty long, and that's actually been doing quite well. And even I think bond DI, or the global bond, has done reasonably well this year, just because of that. But you can start to see what kind of things that we hold in this exposure. As I click on the taxable bonds, you can see exactly what's going on. We've got there's quite a bit. The short-term bonds not so much, but all the longer-term stuff, high yield, inflation protected, and all that. And maybe it's worth, I don't know if I have it selected or not, but maybe we could bring up that new Premier that you built out.
Yeah, the high yield, we could easily subscribe to that.
Yeah. So I'll let's what time we're getting here, 1:30. So yeah, let's go ahead and do that real quick, because I think that there's an advantage to taking a look at that. And let's just go to those subscriptions, and it looks like do I have everything?
Yep, you do have it subscribed. So just go ahead and click on the main page.
Yeah, Mitch always has to tell me how to use the software.
Make sure you left click.
It's helpful.
Right click.
Yeah, I am getting older. I know. It's just yeah. Anyway, so we'll take a look at this with these. Mitch, since you built that, why don't you go ahead and take and drive and just talk a little bit about what the holdings are and all that kind of stuff.
Yeah, so this is as the name states, it's a high yield portfolio. So what I did is I grabbed 5 pretty familiar high yield bond funds, names that have been around for a while, so I could put this back all the way to 2000. And part of the reason for this is because I wanted to grab something that did have a little bit more oomph to it, if you will, that typically pays out a pretty good return. And I also wanted to see how well, this was sort of an experiment as well, to see how well the system would work with just a basket of high yield funds. So by removing some of the other less returning funds from the mix on the bond side, I just wanted to work with these 5. Even as it is, 5 funds may be a bit excessive. If I were running actual dollars with this, I might toss in maybe one other bond fund, like an intermediate term bond fund, for slight diversification, or I might just hone it back to 3. But what I did is I just thought I'd grab a mixture of some quality bond funds. As you see right now, we're invested in 4 of the 5. We're 96% invested, so we're about as fully invested as you could get with this fund. And then going backwards in time, you can see that this has done very, very well. You can see that it's had some pretty solid returns over the years, minimal downside participation, even in years like 2008, when especially the high yield bond market got hit pretty hard. This did have a 5% pullback. 2001 was the worst year. It had a loss of 8%. So there were some times where this did experience a little bit of volatility, but really so did all the other bond funds in those time periods. But afterwards, it's had almost equity-like returns as people have tried to find a place to park those assets that are viewed as safer as opposed to the equity market. So this has done very well over the years. And if we go over to active stocks, you can see what that list is.
Yeah, and this, is there a fact sheet on this yet?
Not yet. This is one of the new ones that just got created. So we will be creating a fact sheet on this.
Okay.
Actually, probably today after I get the stock screening taken care of.
You better. All these promises. I think something, anyway, we'll leave that go. But yeah, I think that, go ahead and go to the constituents, I guess. Were you going to go through that?
Yep. Give me 1 second.
Yeah, and I think that, what we've seen from bonds this year, and this is the opposite of what the expectations were, right? Everybody was expecting yields to go up this year, and even the title of our annual outlook was called the normalization of markets, but that actually has been happening. The markets have been normalizing from the standpoint of how cash flows are going, even though we've seen some pretty good cash flows go into bonds. I mean, the expectation was still, and it still looks like the right expectation as I look back in hindsight for yields to actually start to move higher sometime in the last 2 quarters of this year. So go ahead, Mitch.
So as you can see here, it's just a compilation of various different high yield bond funds, some names that have been around for ages. We've got Invesco, Principal, Mainstay. Then we also have the Northern High Yield as well as the Northeast Investors. Each of those are high yield bond funds. You can click on Q here, and you can see how far back these go. They've all been around for well over a decade. So this portfolio as a whole goes back to 2000 itself. And then as far as the open positions, you could see where we're at right now. Again, almost fully invested. And each of these have some pretty sizable gains. And you see here that 3 of the 4 positions that we're long in did come around in late fall, right before Halloween of last year, when we had that big influx of bond positions. And we've been long that ever since. The longest position that we've held onto is this Northeast Investors position, going back to September. That one's experiencing a nice 25% gain on that. We are using weekly trade systems on this. The way I mapped it out, I let the system determine the optimization on this, and coincidentally, all of these happen to be patched through to the 1.2 system as opposed to the 3.2. So typically when you build out a portfolio, you'll see that we'll grab about 50-50, just like the database, where 50% will be on the 1.2, 50% will be on the 3.2. For whatever reason, each of these bond funds have done better on this 1.2 trade system.
Well, if you look at mutual funds in general, I think you'll find there's more 1.2s than 3.2s.
It's a good question. I'll have to take a look on that.
I'm sure you'll go through and look at it, but I'm pretty sure you'll find that there's a larger percentage 1.2 versus 3.2 on mutual funds. It's usually been that way for quite a few years now. Okay, let's go ahead and let's take a look at some of this other stuff that we've got to look at. I want to go back and let's go back to the charts now. I just wanted to cover that while we were talking about bonds. And let's go back to looking at the yields real quick and the expectations. As I said, we've almost lost all the downward pressure on these indexes at this time from on the 10-year. There's almost virtually no downside on the short term. Still a decent, we're just below trend level on PPM2, and we're maintaining a trend level on PPM3. If we go and look at what the numbers are, we've seen this before, it's 261 all the way to 272 is moving average resistance. And if we go and look at some of the Fibonacci stuff, we'll also see that is the case on the daily charts. You'll see there's some expectations right now that there's a very small target, just bring that up, 275 range, actually 270 to 278 is a short-term target. So there is some upside on the interest rates. Doesn't look to be material. Those aren't really material numbers. So possibly over the next several weeks, should this continue to consolidate, and if we do get a slight uptick on rates, we might see the market start to take some profits on some of these bonds that we've been long in for a while. So let's go and look at our friends over in crude oil. Take a look at that. I think I did have the yen is still flat. It's like not doing anything. It's like watching paint dry, so I won't waste our time talking about that. But let's go ahead and look at crude oil. And let's get off of this chart and get onto a weekly graph. And I also want to take the models off of this thing.
In regards to the tally, I did take a quick look at the system, and you are right, about 58% of all mutual funds are mapped to the weekly 1.2 system, whereas only about 42% is on the weekly 3.2.
Yeah, the old wisdom plays off once in a while, you know. We've had Mitch has actually built some pretty cool internal systems for us to get much better transparency in our database than we've had for many years. It's always been there. We just didn't have a way to get to it. And part of the trade impact charge, part of the all the other mapping that we have put together is able to do that. So we're continuing to try to find tools that will be able to give more transparency, so we'll all have a better idea of what's going on. I think having a context of what's going on in these different markets is really helpful, and I'm hoping that these market thunder shows are helping give you perspective of what's going on in the markets. Because I know we came in with some buys last week, and the market finished off at lower end, and and here we are back down 99 cents on the day. This market's still very biased to the upside. And by the way, just about every trade that's ever put on by you, me, VPM, whatever it is, has a tendency to have some adverse excursion. Otherwise, you never buy at the perfect point. Sometimes you get lucky and you buy, but you're always going to see some negative move against most trades when they come on. It's just the nature of being involved in the market. So it's Murphy, it's everybody. It's like, well, we've got to challenge them to see how much they believe in what they're doing sometimes. But it's really about finding these breakout patterns. VPM attempts to buy at the place where there's going to be the least amount of adverse excursion, but we've seen some of these elongated patterns, sort of like we looked at the yen that's been on for a long while. There's other stocks that it will hold down. I think we looked at gold is down 8 to 10% since it bought. It's just still going in that pattern. It's not breaking down to signal an exit, and it's not going up. So it's just been kind of drifting. I always call them the creepy crawlers.
Yeah.
But going back and taking a look at crude here, I'll get off the screen so I have a nice clean shot here. This is the weekly crude. You see last week we saw it move up. It's very quiet today because nobody knows exactly what's going on with the Iraqi situation and what's going to happen from there. But I think they've actually got the production, from what I've been able to read, up to about 4 million barrels a day, and that's impactful to a point in the world supplies from a daily supply level. And of course they're always talking about our strategic reserves and releasing that to try to keep prices down and those type of things. I guess maybe they should I'm not sure strategic is the right word for that reserve stock that we have. It's maybe it should be political reserves, how to keep prices down when the natives are getting anxious. But the bottom line is, we'll go through a couple patterns here. This crude oil chart has been in the same pattern for quite some time. There's really not a lot of features here to look at from the standpoint of what's going on a technical basis. However, PPM, I'm in the way now, but PPM 1, 2, and 3, 0.45 positive, 0.6 is the PPM 2, and the PPM 3 is flat. So we do have an uptrend. We do have trend mode on this. So we are seeing this expansion. Looking at some of the Fibonacci numbers that we have here and what the expectations are, we're looking at a target of 109 to 110. That's not far away from where we are right now, just a few bucks higher. We're 107.03 right now. So that's no big deal, but we do have trend mode. Let's go and look at the monthly graph. And this has been the same old pattern. Here's the collapse in 09, and then we've seen the consolidation. So let's just say that we're gonna retrace some portion of this. I'll do the numbers first, and I'll put the lines up here so we can see it. You know what I'm going to do? I'm going to use a different tool because I think it'll be more interesting to see this. So we'll put in these lines here. You can start to see what the expectations are for this, and this is not going to be possible for you to read. They're pretty small from that standpoint, but you're looking at the potential for it to go to around 117 minimum, and the possibility of going to 132 and as high as 150 on this index here, and that would be pretty interesting to see that type of pattern unfold. But this is an amazing base pattern. Bring up the whiteboard here for a second. And one of my great calls of my lifetime back when I was back in 1991, right before the Gulf War, I worked for a firm. I was the head financial analyst. We had 4,500 reps, and one of the things I said was around May, we started buying crude oil really big, and the cycles, everything was coming into play. Very, very similar to this pattern here back in the day, and I thought that crude oil could go to, it was at $18 that we could easily go to between $32 and $40. Well, the Gulf War happened and we went to about 40, which was a big number back in those days, considering the price of crude doubled during that time. And the reason why that came, it was a similar pattern. It didn't have this breakdown before it, but it was one of these patterns where it's starting to move up. And we don't have any good Fibonacci stuff, but this is what I was just discussing, going up to even in between these two lines here, this line here that I've drawn, that would be the target range. There was a former Fibonacci target that was right into that range. We'll have to see if anything evolves out of this pattern that's here. And the extreme would be probably closer to the 0.618 retracement number, which pushes the market back to 147/150 range. So there's some upside potential here. Whether it gets up to the top end of the range like what we've seen here in the past and gets up to this, we're pretty much at the upper end of the range and falls back in it, we continue this stable pattern, that's yet to be seen. But certainly if we start to break above some of these numbers here, such as, let me just get rid of that Fibonacci stuff. It should get rid of it, but it's not, because I'm live and it wants to be difficult. Well, we'll leave it on there then, since it doesn't want to leave us. But this pattern is becoming very bullish. If you look at the PPMs on a long-term basis, we're looking at the 0.12